Hey everyone, rental analysis part 2. So we're going to dive a little bit deeper into analyzing a property. We're going to go through some specific examples here. So pull up a spreadsheet that we created. This is down below. You can take a look at it in the comment and you can download this for yourself to use to analyze properties. But what we'll do is we'll walk you through how to fill this out and what it's going to compute for you and how you can analyze if a property is going to be a good rental property or not. Apartment in Burnaby and an apartment in White Rock. I kind of picked a good investment or a relatively good investment and what looks like a poor investment based on the numbers. So we have a 2-bed, 2-bath Metrotown condo here, 1989. So a little bit older, but quite large. We'll pull the numbers from the listing description and then put them into this calculator. So we have the purchase price, estimated monthly rent. That we pulled off of Facebook. So we talked about that in the previous video. If you go on Marketplace, you find a bunch of similar listings to this one. Don't just pick the highest ones, pick the ones that are maybe in the middle to low of the price range, and you can kind of figure out how much you're going to get for rent based on that. And pull off the monthly taxes from the listing report. So in this case, you have a yearly tax of $1,505 and divide that by 12 to get our monthly taxes. Strata fee, $349. Maintenance and repairs, $200. That's just an estimate. You can see for the White Rock condo, we said $100. So, this is per month. So $1,200 a year, $2,400 a year. In comparison, it's older. You're going to have more repairs. Of course, that's just an estimate, so it can fluctuate there. Insurance, again, we just estimated at $50 a month. We're going to exclude a management fee. In this case, we're going to assume that you're managing it by yourself. Just makes the numbers look a little nicer. So after inputting those and your down payment, which has to be at least 20%, we talked about that in the previous video. Assumption of an interest rate of 5%. So depending on what interest rate you're actually going to get, you can change this variable and see how it affects the numbers immediately. And then an amortization of 360 months. Now we can calculate our income statement. So gross rent for the Burnaby apartment, $3,200, $2,400 for the White Rock apartment. So even though the purchase price is quite similar, $649 to $628, you can see the rent for the Burnaby apartment is way higher, way more desirable than the White Rock apartment there. So after our vacancy, now Vancouver vacancy, is it really 2%? It's more like 0%, but we'll say if you have a month where you miss rent, that can contribute to your vacancy there. And then your operating expenses, which we inputted here, we'll take that off of our rent to get our net income. And based on our net income, we're going to subtract the interest portion of that, and that's how we're going to get our principal pay down, which we discussed last time. If you're curious about the cash flow excluding principal pay down, check out our previous video on the rental basics there. But you can see in each case here, the Burnaby apartment is $248, and then the White Rock apartment is negative $453. So not the best investment. And then your actual cash flow in both these cases is negative if you include your principal payment there. But I'll hand this over to Jesse. We're going to get more into nitty-gritty numbers for how you can analyze whether or not this is a good investment.
Sure. So you can see the purchase expenses here. You got your property transfer tax, your lawyer fees, your mortgage amount, down payment that's required. So your total purchase cost is actually $661,000 after your fees. If we look at the more metrics portion here, this is your debt service coverage ratio. You'll probably see this DSCR. And this is how much your rent covers your debt after your expenses. You can see it, that's 89%. So it's actually below 100%. So typically you want that number to be above 100% because that would mean that you're positive cash flow. And the White Rock condo is 64%. So typically the target there should be about 1.1%. So you have a little bit of positive cash flow. Conservatively, if you can get it over 1.25%, that leaves a lot more room for rents to go down or for anything like that and still be positive cash flow. That's typically on commercial properties like big apartment buildings. Banks want to see like 1.1, 1.25% debt service coverage ratio. And that's because those loans aren't backed by personal income from the borrowers. Whereas with these condos, the loan is backed by your personal income. The bank uses your income to qualify you as well as half the rent usually usually. So they know, okay, if it's negative cash flow, they don't really care because they know that your income's going to top it up. And you're going to cover that with your hard-earned dollars from your day job. The gross rent multiple. So that's how many times the purchase price is a multiple of the yearly rent. 17 times, 22 times for the White Rock condo. Obviously lower is better there. Gross rental yield. And so that 5.8% for the Burnaby condo, 4.5% for the White Rock. That's kind of like an inverse of the gross rent multiple. That's just the percent of the yearly rent is as a percent of the purchase price. And your operating profit margin, 75% on Burnaby, 69% on White Rock. And that is your gross rent minus your operating expenses, property taxes, maintenance, strata fee, those kind of things. Doesn't include your interest. That's separate. So if we get into the key metrics here, the projected 5-year profit, we're going to talk about that in a future video. There's some appreciation assumptions we make there, and it's kind of a bogus number. It's not going to be that, but it's just like giving you an idea of like, hey, if the property goes up 3% a year, this is how much you can expect to have in 5 years in equity and profit. Doesn't include selling fees either. Cap rate. So this is super important for rental properties. This is basically your net operating income. So your rent minus your property taxes, strata fees, maintenance, blah, 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 divided by the purchase price. So this is basically like if you use zero debt on the property, if you just bought it 100% cash, this is how much your yield would be. Your rent every year. It's basically a dividend if you don't use debt. That's how you can look at this, 4.37%. And your appreciation's on top of that. Of course, almost everybody uses debt to purchase real estate. So that's not actually how much cash flow you get. That number is your cash on cash return. So if you used 100% cash to purchase the property, no debt, your cap rate and your cash on cash return would be the same. They'd be both 4.37%. But because we have to pay principal and interest payments each month, your cash on cash return is actually negative. And this number is based on the cash that you receive every year divided by the equity, the down payment that you put down. So it's not about the cap rate, it's about the purchase price and the net operating income. The cash on cash is about the equity you put down. And then the denominator is the actual cash that you receive after paying your mortgage. So a very different number. Ideally, in a lower interest rate environment with reasonable prices, your cap rate could be like 4.3%, and then your cash on cash could be like 10%, which basically means that like for the money that you put into the deal, let's say you put 200 grand down, you're going to be getting, if that number is 10%, you're going to be getting $20,000 in cash back every year, which is amazing. I mean, imagine buying a stock where it appreciated and you got 10% back in dividends every year. That's like an awesome real estate deal. If you can find that in a major metro area, jump on that. And there are time periods when that's available. So watch out for those. That's an incredible deal. As you can see right now, it's negative 3%. Not ideal. Hopefully rates go down and juice those numbers up a little bit. All right, return on equity from rent. This is probably the truest indication of your actual profit each year from your rent. Because what it is it takes your down payment in the deal, the money, the cash you had to outlay, and then the denominator on that is the amount of money that is either getting to you through cash flow or principal pay down. Because your principal pay down is actually equity that you're building in a sense that is profit from rent, which cash on cash doesn't include because you're paying, if your cash on cash is negative, you're paying into your cash flow is negative. But a portion of that negative is going towards your principal, and your principal is still getting paid down every month from the rent. So this measures how much the renter is basically paying down your down payment every year, and it's 2.1% is how much is on your down payment is actually profit from rent every year in the form of equity principal pay down. So that's a good number. So these are some heavy duty numbers. If you haven't seen these terms before, it probably gets a little bit confusing. I did a finance degree at SFU, so even I get confused by these sometimes. So if you guys want more clarity around how to use these, feel free to reach out and we're happy to walk you through them. But in general, the numbers to watch are watch your cap rate. You want to obviously find the highest cap rate possible for a quality property. And then your cash on cash is super important because that shows if you have to fund the property negative cash flow each month. And your return on equity from rent is also super important because you could have a low cash flow deal, but if you're paying down tons and tons of principal every month, you're still profiting. And so that could be a high number and it might still be a good deal.
Yeah. So if you were a beginner investor and you were going to use this calculator, Jess, what would be the numbers that you would look at and kind of the thresholds that you kind of say, okay, this is a decent investment?
Yeah. I mean, obviously the holy grail is like if you can get that cash flow neutral or positive, that's like the first thing to watch for. But like I said, also watch for the return on equity from rent. So if you're like, for example, if you want to change this, if we all of a sudden do a shorter amortization, let's make that 300. Well, our cash flow goes deeper negative, right? So now we have less cash flow, but our return on equity from rent stays the same because we're actually paying down the same amount of principal every single month. And so that still is high.
Awesome. So if you enjoyed the video, don't forget to like and subscribe and go into the comment section, make comments. If you have questions, we'll answer them in future YouTube videos.